Hello and welcome. Moss Adams is pleased to present today's webcast to members of Philanthropy California, Unpacking the Form 990, a closer look. The presentation you are about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. And before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key.
All right, today's webcast is eligible for 1.5 CPE credits, and for the National Association of State Boards of Accountancy, to qualify for these credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. And now I'm pleased to introduce Monica Banks, Coordinator of Professional Learning and Family Philanthropy at Southern California Grantmakers. Monica?
Good morning, everyone, and welcome. My name is Monica Banks, and on behalf of Philanthropy California, which includes Northern California Grantmakers, Calis of San Diego and Imperial Counties, and SCG's Professional Learning Suite Evolve, we're delighted to partner with Moss Adams for another exciting financial literacy program. I'd like to take this moment to show our sincere gratitude for this continued collaboration. Thank you so much, and I will pass it back to you, Amy.
All right, thank you, Monica. It's nice to have you with us today. And our presentation will be given by Maggie Elliott, Senior Manager at Moss Adams, and Cherie Williams, a manager here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Maggie to get us started.
Thank you. Good morning, everybody. We'll just kick it right off the bat here with the purpose of the Form 990. So even though public charities do not pay federal taxes, they do have a filing requirement. The 990 series returns are often referred to as informational returns. And what's unique about them is that they are required to be made public. This means that anyone can access it for any reason. In fact, no reason needs to be given to request a copy. The filer must make the Form 990 publicly available for a period of 3 years from the date it is required to be filed, and this includes extensions, or if it's filed late, that would be the date of filing. However, it is important to note that organizations aren't required to make publicly available the names and addresses of contributors, Schedule B, which Cherie will discuss later in this presentation. Part 6, Section C, or the disclosure section questions on the form, specifically address where and how the form, as well as the tax exemption application, which is the Form 1023, can be found. So who's looking at the 990? IRS certainly does, as do the state authorities, and the two can act independently. Potential donors, competitors, and media are often interested, and in some cases, it could be those that do not agree with the exempt purpose or activities of a given organization. We have certainly seen some of the larger, higher profile organizations be scrutinized on social media, blogs, and in the news. And I'm sure many of you are aware of the recent news about NRA and Black Matters Life. So it's certainly something that's popular and comes up. And with that, Amy, we have our first polling question.
All right, thank you. So our first polling question out of the 6 questions is, what is your most significant use of the Form 990 in grant making? A, it's our main guide to understanding an organization. We look at all elements of it. B, we verify financial and other information provided in our applications with the 990. C, we review it for completeness and accuracy to get an understanding of an organization's infrastructure. D, I don't use it in grant making, but I look at Form 990s for fun. Or E, what's a Form 990? And to respond, you will need to click the button next to the answer you choose and hit the submit button in order for it to track your CPE progress. And if you can't see the submit button, you will need to enlarge your slide area. We'll leave this up for another 5 seconds to make sure everyone gets their credit. Okay, here are the results.
Thank you. That's a great feedback. Looks like most verify financial and other information provided and review it for completeness and accuracy. And of course, to understand the organization a little bit more. So in addition to the IRS database, there are numerous websites that house 990s and provide ratings. My personal go-to is Guidestarorg, and they claim to be the world's largest source of information on nonprofit organizations, but there are many others that are listed here. So certainly options out there. So moving on and stepping back a little bit, let's look at the world of nonprofits. There are 2 types. Those are our tax-exempt that are charitable and non-charitable. The distinguishing factor being the favorable and desirable charitable deduction under IRC Section 170. It's the IRC 509 that makes the statutory distinction between private foundations and public charities. It essentially provides that all organizations under 501c3 are private foundations, except the types under 509A1, 509A2, 509A3, and 509A4. And if the numbers mean nothing to you, all those are what we think of as public charities. The type A, or the first type, are the organizations that engage in inherently public activity, such as churches, hospitals, governmental units, and certain organizations related to colleges and universities. Type B are publicly supported organizations, and we'll examine the 2 types, 509A1 and 509A2, more closely when we get to Schedule A. And the third are supporting organizations. Of course, there's also the private foundations, and those can be either operating or non-operating. The latter often referred to as grant making, and those are definitely more common. And with that, I will turn it over to Cherie to dive in more in depth into the filing requirements.
Thank you, Maggie. All right, let's get into who files the Form 990, the 990EZ, and the 990N. So the 990 is a series. There's 4 different types of returns. This most simple return being for smaller organizations with gross receipts of less than $50,000. They can file the Form 990N, and that's pretty much, that's really a postcard. I know that the IRS likes to talk about postcards. This one really is. It's a really small form, and this California equivalent is also a very small form. Has to be filed online, as do all of these now. The second form for organizations a little bit bigger, their gross receipts less than $200,000, but assets more than $500,000, they file the 990EZ. That's a more complex return, not as complex as the 990, but it does require detailed financial information and compliance questions. And then there's the Form 990, which we all know, if an organization has gross receipts of less than $200,000 or assets worth more than $500,000. I think I said that wrong with the 990. easy is less than 500,000, but it's right there. If assets are more than 500,000, then the organization files the full Form 90, which is a 12-page core form with lots of schedules. It's the biggest information return out there. And then if an organization is not a public charity or loses its public charity status and becomes a private foundation, the organization files the Form 990-PF. And private foundations do not file the Form 990-N. So if an organization has less than $50,000, but it is a foundation, it would still file the Form 990-PF. And even if an organization does not have any activity during the year, no income, no expenses, they are required to file a return. There are certain entities that are exempt from filing requirements. That includes governmental entities, churches, and certain foreign charities and non-governmental organizations. Moving on to what happens if an organization does not file the 990, the penalties can really add up. So for smaller organizations, their penalty is $20 per day, maximum of $10,000 or 5% of gross receipts. Larger organizations, if gross receipts exceed $1 million, the penalties are as large as $100 per day. That's why it's important for organizations to get the return filed either on time or at the extended due date to avoid paying these penalties. California actually does not want organizations to pay penalties from the organization's funds, meaning the board of directors would pay the penalties or the fines or the judgments. The other thing is if an organization files an incomplete return or files the wrong return, they will get an IRS notice. There's like 3 standard IRS notices that they send to tax-exempt organizations: filing an incomplete return or filing the wrong type of return, meaning you file a 990 and when you should have filed a 990. Those will trigger an IRS notice. Usually they come with instructions. The nonprofit completes those instructions and sometimes has to send a reasonable cause letter, which you can see here, reliance upon a knowledgeable professional. If the organization furnishes professional with all the necessary information, they send all of that with the IRS notice and hopefully resolves any issues with filing requirements. All right, guiding principles of the Form 990. So the reason why the Form 990 is complex and so can be burdensome sometimes is to enhance transparency. Many members of the general public rely on the 990 as their primary or sole source of information. As Maggie stated before, we see how certain organizations and even their leaders are kind of put on display when an organization's funds aren't used correctly or when they're allegedly not used correctly. The 990, the public perceives the tax-exempt organization could be largely controlled by the information presented on the Form 990. The transparency is the top reason why the 990 is the way it is. The 990 also is designed to promote compliance. We'll go through Form 990 Part 5, which is pretty much the compliance section of the 990. I call it the boring section because it's just about telling the IRS about forms you already filed. It's very detailed. It eliminates unstructured attachments, and it allows the IRS to efficiently assess risks of noncompliance. And depending on who's deciding this, the 990 also minimizes filing burdens for exempt organizations and reduces record keeping. So to us who prepare the returns and organizations who review the returns and organizations who have to file these returns, the 990 can seem burdensome. But the way it's designed, it actually creates less of a burden for the IRS because it asks so many compliance questions and has so many disclosure requirements. All right, so now we're going to get into the core form of the 990, but first we'll do a polling question.
All right, thank you. So the second polling question is, which of the following parts of the Form 990 is of most interest to you? A, compensation reporting, B, functional expense, C, public support, or D, lobbying issues. And just a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 5 of the 6 polling questions. All right, leave this up a few more seconds. All right, here are the results.
Okay, so it looks like most people are interested in the functional expense. That's where we see all the program services, fundraising, all of that. And people are also interested in the public support, which makes sense because that's where the grant makers come in. All right, thank you for that. And now I'll pass it back to Maggie to keep on talking about the Form 990.
Thank you, Cherie. So starting off with page 1, the heading, providing basic information, which includes the name and the address of the organization, its EIN, the telephone where it could be reached. Box B provides an opportunity to indicate an address and or name change, whether it is the initial, amended, or final return, and also if the organization is in its very early stages before the Form 1023 is even approved by checking the application pending box. Box J does report website information, and I'm sure it's no surprise that it's something that's often looked into by readers and even the service to see details about activities, particularly those that may generate unrelated business income or those that are political. So for example, if a Section 501c3 organization posts content on its website that takes a position with respect to specific legislation, the posting may well constitute lobbying. I know we often look, especially for new clients, look at their websites to see what they are showing, how they're presenting themselves, and all those details. Box M shows the state of legal domicile, and that's really more of a state issue. Part 1, which is right below the heading, is a snapshot of revenue and expenses for both current and prior year, and it gives you a good high-level overview of the performance of the organization. I'm sure many of you have heard certain rules of thumb, and the IRS does run queries to determine how much does it take to raise contributions revenue, for example, for the entity. So a good rule of thumb here is between 5 and 15%. But please remember that there could be reasons of why an organization does not fit into a certain range, especially during its initial years of existence, or if they're running a big capital campaign, for example, or perhaps when they have the same donors year after year. So fundraising costs are those that are associated with seeking, soliciting, or securing contributions, which can be direct. So for example, personal costs, printing and mailing costs, fundraising event costs, and other direct mail. But they could also be indirect, where a certain portion of salaries and overhead are allocated as fundraising. While the direct costs are easily identifiable, allocating indirect costs can present more of a challenge for an organization. The methodology should be reasonable, consistent, and periodically reviewed, and I certainly urge those that are preparing or reviewing the forms to also challenge it as opposed to relying on the same amount year over year. Some of the common metrics are percentage of time allocation, square footage allocation, or simply a percentage of direct costs. While that seems relatively simple, tracking this often is where it gets a bit more tricky. Tracking it in real time is probably going to provide most accurate information. However, it may be too cumbersome for the organization. So again, reviewing and estimating annually, as long as it is reasonable and consistent, is okay. And now over to you, Cherie, to continue to page 2.
Thanks, Maggie. So page 2, part 3 of the Form 990, this is where the exempt organization reports their program service accomplishments. They start off with providing a description of the organization's mission, different from page 1, where the organization briefly summarizes their mission. This is where they get to provide the full mission if it can't fit on page 1, or if they want to add more detail as what's disclosed in their articles of incorporation or on their website. Lines 2 through 4 are, they look bunched in there, but they're actually pretty important. So program service accomplishments are actually reported on the Form 1023. That's the tax-exempt application. But often organizations will take on new programs, and Form 990, Part 3, Line 2 is where they disclose that information. This is important because it lets the IRS or the reader know whether this new activity operates outside legal boundaries of their organizational documents. It's important if an organization does not disclose this, as preparers, it's important for us to compare Part 3 to their tax-exempt application or even Note 1 of the audited financial statements to identify whether or not there have been new activities that need to be disclosed. The reason is we want to avoid the IRS challenging any new activity in case the IRS might come back and say, hey, this does not further exempt purpose. And we want to avoid any type of IRS not audit, for example, if there is a new fiscal sponsor or something like that. And if an organization misses this in 1 year, it's okay to report it in the next year as long as we're disclosing any new activities. Another part of Form 990 Part 3 is line 4. It's actually the biggest part of the form. It's a chance for those of us who prepare the return to step out of our accountant box, even though we're going to go into the numbers, and kind of step into our storytelling box. So on Form 990 Part 3, we have to disclose the top 3 program service accomplishments, and top is actually defined by expenses. So if an organization spends a lot of money in one area, that would be considered the largest program service accomplishment. We have to disclose the program service revenue. It's important to properly classify the program service revenue because it has public support test implications, which we'll get into later. And we also ascertain whether the organization's exemption is truly charging the direct recipients for the charitable services which they are receiving. So for GAAP purposes, sometimes donations, things like that will be considered program service, but for the Form 990, we'll consider those fee for service. And we have to identify that correctly on the Form 990. All right, moving on to Form 990 Part 5. This is where we tell the IRS what other compliance forms the exempt organization completed. So on Form 990 Part 5, Line 1A, we tell the IRS how many 1099s the organization filed. On Line 1B, we tell how many Forms W-2G were filed, and those are the forms provided if there were any earnings from gaming, things like that. We also have to make sure the organization upheld backup withholding requirements. On lines 4 and 4A and 4B, we have to disclose any foreign bank account reporting, which is this form called the FBAR, if an organization had foreign bank accounts, things like that. Part 5 also has other compliance requirements that don't necessarily include forms that were filed with the IRS, but also donor acknowledgement requirements. For example, say an organization had a charitable fundraising dinner and $25 of the donor's contribution went towards the dinner and $75 went towards the organization's charitable contributions. The organization has to disclose to the donor which amount of the organization's donation was actually tax deductible. They don't have to disclose to the donor the value of the non-charitable donation, but either way, on Form 990 Part 5, lines 7A and B, they have to let the IRS know if there were any contributions that were partially for goods and partially for just true charitable contributions. All right. There's also other compliance requirements here. For example, if large non-cash contributions were made, there's a Form 8282 filing requirement, contributions of qualified intellectual property, and also contributions of vehicles requirements. Form 990 Part 6, this is the governance section of the form. This is where the organization tells the IRS and readers of the Form 990 what types of governance practices are happening, how many board members are dependent versus is independent, how governing documents are reviewed, things like that. So Form 990, line 1B, is where the organization reports non-independent board members. And these are board members who receive compensation. The definition of non-independent director is actually more complicated. For instance, if a board member receives compensation as an independent contractor, that compensation actually has to exceed a threshold in order for that board member to be considered non-independent. But if that board member receives compensation as an employee, then they are deemed non-independent. So it does get quite complicated, but this is actually a part of the 990, which will tell us, give us insight into any insider transactions, excess compensation, things like that. We also have to report outsourcing of management duties, and line 6 and 7 asks, does another entity control or participate in the governance of the filing organization? Part 6 of the 990 also asks about policies and procedures. A lot of the policies and procedures listed here are not required. For example, it asks if there's a conflict of interest policy on line 12, if there's a written whistleblower policy on line 13, or a written document retention and destruction policy on line 14. While these are not required for tax-exempt organizations, they are considered best practices, and entities who follow best practices are determined to have less risk. The last part of Form 990, Part 6, is where the organization discloses the process for determining compensation, and this is actually very important for organizations, especially with larger organizations where executives, things like that, people like that are paid large amounts. It's important for them to disclose here how their compensation is reported, how it is determined, things like that, in order to defend anyone who wants to challenge compensation to executives and top management. There's also a rebuttal presumption of reasonableness. So if there's board approval, comparability data, and contemporaneous documentation of the entire compensation process, then it also helps defend any compensation amounts reported on Form 990 Part 7. Form 990 Part 6 also asks a list of states which the organization is registered or licensed to solicit contributions. This is a trigger to states to come back and say, hey, you have to file whatever filing form is required in our state. As you may or may not know, Form 990 state requirements are similar to for-profit requirements. They're all different, and if an organization fundraises in a certain state, they are responsible to look at the requirements and know whether or not they have filing requirements in that state, or sometimes they'll come to us as preparers to make that judgment and file those forms for them. All right. And moving on to Part 7. Part 7 is a very complex part of the return. We encourage you to put any questions on Form 990 Part 7 in the chat or ask them to us after the presentation. Form 990 Part 7 is where we disclose compensation information for trustees, board members, directors, officers, key employees, and highest compensated employees. For now, we're going to talk about Form 990 Part 7, Section B, because this is where independent contractors are disclosed. For Form 990 Part 7, Section B, only the top 5 highest paid independent contractors are reported here. This is actually a key part of the Form 990 where NRA, Black Lives Matter were kind of ousted on for insider transactions, things like that. It's where outside readers can identify insider transactions, related party transactions, private benefit transactions, professional fundraisers, things like that, that might have not been disclosed on the Form 990 Part 7, Section A. And with that, I'll move on to the polling question.
All right, thank you. So the third polling question is, what financial metric do you find most interesting? A, fundraising effectiveness, B, functional expense allocations, C, restricted ratio, D, managing debt, or E, we don't look at financial metrics when we review grantees. And also, if you would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. All right, a few more seconds. Here are the results.
All right, so fundraising effectiveness is what most of you find the most interesting, all right, and functional expense allocations. Close second. A lot of people interested in the functional expense. Okay, moving on to Form 990 Part 8, I'll pass it back to Maggie.
Thank you, Cherie. So we'll start off with the revenue section. I know many of you are interested in what's coming up next, but Statement of Revenue breaks out the details of revenue from Part 1 by the function or type of revenue, or the rows, and also by category in the columns B through D, so the programmatic, unrelated, which are those that are taxable and reported in the 990T, as well as the type that's not programmatic, but is not specifically taxed. So there are four main groupings of revenue for Part 8. Contribution revenue, where no goods or services are received in exchange, which are further broken down by type. For example, contributions that are generated as part of a special event, such as an annual gala, are further broken out as such on line 1C. Related organization revenue should be isolated on line 1D, and any government grants or sources on line 1E, and those would include things like CPE funds, for example, which were very common in the recent years. Programmatic revenue is typically generated as a result of fees for services generally related to the charitable purpose of the organization. So for example, a private school that could include tuition and fees revenue, or for a museum, admission fees. Other revenue includes investment income, so any interest, dividends, rental income that's not programmatic, and capital gains, as well as fundraising revenue from special events and or gaming, which are reported net of direct expenses. Although more detail is included on Schedule D for those, and we will get into that a little bit later. So where we see most unreported or underreported revenue is column C, unrelated business income. Common sources of unrelated business income are alternative investments, such as partnership investments, rental property, especially if there's personal services or personal property that's rented, or if it's rented in addition to real property, and debt finance investments. Keep in mind that while miscellaneous revenue may be minimal, different revenue streams may not necessarily be related function income, so it's important to understand and identify the three largest sources in more detail on lines below on 11A through C. Okay, and so if the organization has audited financial statements, the total revenue is reconciled between the statement and the 990 on Schedule D, Part 11. The common adjustments include unrealized gains or losses or other mark-to-market adjustments, donated services and facilities, which are excluded from both revenue and expenses for the purposes of the 990, and investment expenses, which we see commonly netted together for financial statement purposes. The reconciliation is only required if there are audited financial statements that are separately prepared. So in cases of consolidated audits, completion of this section is optional. Further, Part 9 provides the detail of Expenses, and similarly to revenues, they have their natural classification as you would on the trial balance. And there's also the functional classification in columns B, C, and D, allocating between the programmatic, management and general, and fundraising. So again, it is broken out starting with grant expenses between domestic organization, domestic individuals, and foreign entities. A straightforward example here would be if an organization issued a grant or scholarship to another organization or person, the two would be reported separately on line 1 and line 2 respectively. Compensation, and I know that was one of the areas of interest, and rightly so, as it continues to be a focus of the IRS. And on line 5, the form specifically breaks out compensation between disqualified person and other salaries and wages on fiscal basis. Many of the lines address both wages and fees for services that are not compensation. And while the allocation category itself is mostly self-explanatory, and what I mean by that is, for example, if you need to travel to conduct programs, that's a programmatic expense, but the travel costs to get office supplies, for example, on the other hand, would be included in management and general expenses. Exactly how much of an organization's expenses fall into this allocation and how that should be was debated for years. So some of the nonprofit watchdog groups that we mentioned at the beginning graded donor worthiness of a charity based on an overhead ratio. And I'm sure many of you have heard this. And so what is this magic ratio? 80% of expenses allocated to program expenses and 20% of expenses allocated to management and general expenses, also known as the 80-20 rule. So while you often hear that, it's a bit of a myth. Charities shouldn't be shamed into spending every last dime feeding the homeless, but ignoring their own internal needs. Worse yet, some ultimately fudge the numbers altogether to get to fit into these ratios. So most public charities should be spending more on their programs than administration costs in any given year, but barring, of course, any unusual circumstances, but should not necessarily fixate on the ratios other than a high-level pulse-type measurement. When reporting fees for services, such as those that are paid to non-employees, it's important to identify any management fees, lobbying fees. The assessment may be different depending on whether an organization has a 501H election in place, and we'll discuss that a little bit later in Schedule C. And professional fundraising services. Are they registered? Are they reported on Schedule G, Part 1? And again, we'll discuss that in a little bit more detail once we get to Schedule G. So similarly to revenue, expenses are also reconciled to the financial statement if the organization has audited financial statements. Common adjustments are prior period adjustments. More recently, we're seeing some adjustments as a result of the employee retention tax credits, for example. And since those are treated differently for GAAP purposes. And this wraps up the core of Form 990. And with that, I will turn it back over to Cherie to start us on Schedule A.
All right, are we going to get to a polling question here? It looks like we have the fourth polling question pulled up. So, do you review Schedule A for grant recipients? And your options are A, yes, it helps me understand sources of support for an organization. B, yes, we analyze it to see if we will tip the organization. C, no, we do not review it. Or D, not sure.
I apologize, everyone. I was on mute, so I gave you the whole Schedule A spiel and only talked to myself. So we'll go back to the slide after this.
Okay. Yeah, let's let everyone respond to this, and then we can go back to that slide.
Absolutely.
All right, here are the results.
Okay, so you review Schedule A for grant recipients because it helps you understand sources of support for the organization. That's 54.9%, which is the main reason the IRS has that form, so that makes sense. All right, so Schedule A, public support. A lot of you are familiar with this schedule. What can we glean from it? We can glean what type of public charity is filing the organization, which we're going to get into. How broad is the public support for the charity? Is the organization at risk for losing its classification as a public charity? And what grant makers are concerned with is, might a grant provided by the foundation tip the public charity to private foundation status? And we'll get into that as well. All right. Now let's get into the details of Schedule A. So we talked about it. Maggie went over that diagram of tax-exempt organizations. There were charitable and non-charitable. And in that charitable realm are private foundations and public charities. And in that public charity realm, as Maggie explained, we have certain classifications of public charities, most of them defined under IRS Code Section 509, which she talked about as well. 509A1, organizations primarily receive contributions from the government, from the public, things like that. 509A2 organizations typically receive a good amount of their income from programs. So you'll see museums, dance organizations, things that might have program-related services will often be classified under Code Section 509A2. Then there's 509A3, which are supporting organizations. Most of Schedule A is actually dedicated to 509A3 organizations. They have a lot of disclosures because they're so closely tied to another organization, and depending on whether they're functionally integrated or non-functionally integrated, they actually have to meet distribution requirements. So 509A3 organizations we're not going to get into today, but note that most of Schedule A is devoted to them, and we could do a whole separate hour-and-a-half presentation on those types. All right. Moving on to Schedule A, the types of categories. So before we get into the categories, know that there's 5 parts of Schedule A, and as I mentioned before, parts 4 and 5, which have the most pages, are dedicated to supporting organizations. All organizations complete Part 1, but churches, schools, hospitals, organizations like those who don't have to complete the public support test stop at Part 1. Operating public charities, well, actually, I'll go to donative public charities. So donative public charities, meaning they receive most of their contributions from the government, things like that, and don't have too many fee-based programs, they're going to complete the public support test on Form 990 Schedule A Part 2. And then operating public charities, which we discussed, the ones that have program service fees that could play a major role in their support, complete Schedule A Part 3. Okay, reason for public charity status. So as we mentioned, every public charity completes Form 990 Schedule A Part 1. Certain organizations are deemed charitable, and then no further information is needed. Part 2 might be completed in order to meet the special rule for Schedule B. We'll talk about Schedule B later, but know that some organizations might not be required to complete Schedule A Part 2, but it might be to their best benefit due to reporting requirements for Schedule B. And then other organizations need to meet a numeric calculation of public support, which we're going to get into. And now I'll pass it on to Maggie, who's going to talk about public support and foundation tipping.
Thank you, Cherie. So tipping occurs when a public charity can no longer meet the public charity support test required by the IRS for 2 successive tax years. The first year you get a pass, but after 2 years of failing, the public charity is automatically reclassified as a private foundation and required to file or start filing the Form 990-PF. So we most commonly see this when a public charity receives a large grant from a private foundation, which quote, tips the public charity into the private foundation status. Most often our private foundation clients come to us with the question of how does the tipping occur and how can it be avoided? So for the organization, it is important to understand and monitor the test, particularly if it's starting to trend down. But in general, support from federal or state government and contributions from general public is what's considered good support and should be substantial part, or at least 33 1/3%, or for 10% plus or 10% for facts and circumstances test. Organizations that received almost all of its support from program revenue will likely not qualify, or organizations that end up continuously supported by a few large donors. And at the bottom here of this slide, there's a visual of the 5-year test. So the next slide shows how the percentages are calculated, and it's high level is using total support as the denominator and public support as the numerator. So shown here in more detail, the numerator includes all contributions and grant revenue other than those considered excess contributions. And in the denominator, in addition, you have to public support, you include investment income, however, no realized and unrealized gains, net income from unrelated business activities, which is what's reported on the Form 990-T, and also other income. So I already alluded to the concept of substantial contributors, but what is a substantial contributor for these purposes? So anyone who over a 5-year period contributed 2% or more of total support is considered a substantial contributor, and therefore any excess from each is excluded. And this is why larger donations from a contributor can drive down the public support percentages. It is important to know that family members and controlled entities should be aggregated, and possibly contributions from the donor's donor advice fund or their DAF. So again, we show an example here at the bottom of the calculation where the 2% of the support for the 5-year period is $100,000, and the Sally Green, her family trust, and husband's contributions are aggregated together. And where we've seen a lot of this actually come up recently is the result of the CARES Act and the 100% deduction. A lot of donors were incentivized by that and giving very large contributions, which in some cases did affect the support test. So moving on to part 3, the operating public charity. Organizations classified under IRC 509A1 and under 509A2 have similar basis for public charity status in that they both receive support from public sources. While many of the same factors apply to 509A2 public charities, there are 2 significant differences. First being the source of public support. So for the 509A2 organizations, more typically it consists of gross receipts derived from an activity that is related to the organization's exempt function. And the second is that the IRC 509A2 places a limit on the receipts of certain types of income, so less than 33 1/3% of its total support should come from investment income or net unrelated business income. So the 509A2 test omits remittances for both contributions and fees for services from all persons who are disqualified persons within the meaning of Section 4946. It excludes receipts from any person in any tax year to the extent that such receipts exceed the greater of $5,000 or 1% of the organization's total support for that tax year. And we have an example of that on the next slide. So again, similarly here in the example 3, at the very top, there's the 1% threshold. And again, the Sally Green Family Trust and Joe Green contributions are the ones that would be in excess here and excluded. So the exclusion of unusual grants from the calculation of total support and from public support as well generally is intended to apply to substantial contributors or substantial contributions or bequests from disinterested parties that are attracted by reason of the publicly supported nature of their organization, are unusual or unexpected with respect to the amount thereof, and would adversely affect the status of the organization as normally being publicly supported by reason of the size of the contribution. So the most commonly seen example is a bequest from a person that has no connection to the organization. They decide to leave their entire estate, which is sizable, to the organization, and such organization in that case, assuming that person was not a substantial contributor and has not contributed in the past, would be able to exclude that contribution. And most often with estates, we see that, affect maybe a year or two as the estate unwinds, and it's a one-time deal. Certain organizations may switch back and forth between the two tests, so the Part 2 and 3, and that's acceptable. Our recommendation would be to maintain both tests if that's the case. And as Cherie also mentioned, during Part 1, there may be instances where an organization is not required to complete Schedule A, but chooses to in order to reduce the reporting requirements for Schedule B to get to be under that special rules. And schools are good examples where we see that quite commonly. So for supporting organizations, disclosures should be consistent with the core form. Of course, then Schedule I and Schedule R. Line 12G, column V, should include contributions paid on behalf of the supported organization, and column VI may include fair market value estimates of any in-kind goods, services, and use of facilities. And with that, I will turn it back over to Cherie.
Thank you, Maggie. All right, so Schedule A is big and complex, and Schedule B is not as big as complex, and it's not even a public disclosure item of the Form 990, but there's lots that we can glean from this schedule, including how broad the support is to the charity, whether contributions were cash or non-cash, and does an organization understand its public disclosure requirements, and we'll get into that. All right. Schedule B is reporting of anonymous donors and donor-advised funds. The method of accounting on Schedule B should follow the method of accounting for the Form 990. That's important because oftentimes tax-exempt organizations will provide us, the preparers, a list of all contributions during the year on a cash basis, while their financials are reported on GAAP basis or on an accrual basis. And we have to get back to them and let them know that they need to reconcile all contributions based off of the method of reporting on their financial statements. And we'll get into that later, how that can impact the reporting on this return. Another item here to note is you can see here under General Rule, all contributions on Schedule B, all the required contributions reported on Schedule B are those that exceed $5,000 or more during the tax year. There is a special rule where certain organizations can only include donations that exceed 2% of total contributions during the year. And the full explanation is here under special rule. You can read that. The catch is, in order to qualify for the special rule, an organization has to complete Schedule A Part 2 and pass the public support test, which is having more than 33 1/3 from their support as public support. This is why sometimes churches or other organizations that don't have to complete the public support test will complete it so that they can fill out Schedule B based on the special rule. All right. I actually haven't seen that happen that often, but it does happen. Now, as I mentioned in the last slide, a lot of times organizations in their first year of filing the 990 don't realize that the list of contributors has to match their method of accounting. And if they're required to file audited financial statements, that accounting is on the accrual basis. And accrual is a basis required under GAAP. And under GAAP, the organization has to record the total of all year's pledges in the period in which the pledge is made. So if a donor makes a 10-year pledge of $100,000, then we'd have to report the $1 million contribution in the tax year the pledge is made. And of course, there's GAAP requirements for pledges, right? It has to be written documentation and other requirements for a pledge to be a pledge. Either way, on the Form 990, we record total of all year's pledges in the period in which the pledge is made. It requires the organization to regularly review outstanding balances for collectability. Even though we report all pledges, any unpaid portion of a gift will remain in temporarily restricted net assets until received and used, and that's for financial statement purposes. And it's also how we have to look at how to identify potential misreporting of multi-year gifts. We have to review, or sometimes the auditors do this, or the organization has to review current year receipts for memos noting installment or other indicators of multiple payments. The auditors will often perform periodic sample audits of documentation supporting contribution and grant revenue. Now I'll pass it back to Maggie to talk about Schedule C.
Thank you. So Schedule C, lobbying and political activities. The first question is there any political and or lobbying activity that the organization participates in? So on the next slide, Form 990 Part 4 has trigger questions, and if you answer any of these yes, you must complete corresponding sections of Schedule C. So starting with Part 1A, we'll have the narrative description of activities, expenditures, and volunteer hours. For Part 1B, and we hope that 501c3 organizations never get there, and Cherie, you could go to the next slide, but that's where the tax on organization and managers is calculated and where you would report correction efforts. Part 1C is for Section 527 activities, so for the non-501c3s. If you are a 501c3 organization and have a 501h election in effect, and please note that once you make that election, the only way to stop that election is to submit the same form that you did to elect in the first place to remove the election. So the IRS will look for that and matching on your return. And if you answer that trigger question, no, but you do actually have the 501h election in place, you will get a rejection. So that question does have to remain being answered yes, even if you years down the road stop or even do no lobbying or political activity. So with a 501h election, you must complete Part 2 of the schedule. If you don't have the 501h election in effect, Part 2B has a series of questions that, if answered yes, require a narrative description of the activities. And so Schedule C Part 3 is for 501c4 social welfare organizations, 501c5s, which are agricultural or horticultural organizations, and 501c6, which are business leagues, who are subject to the Section 6033E notice and reporting requirements, and of course to the potential proxy tax. Under that section, these organizations are required to tell their members what portion of their membership dues were allocable to the political or lobbying activities of the organization. If an organization does give its members this information, then the organization is subject to proxy tax. This taxable amount is reported on Form 990T. While it's the organization's responsibility to disclose to members the percentage of dues paid that must be excluded as a deduction from their tax returns, that there's of course an alternative to this option. The organization could opt out to provide this disclosure and incur the tax liability directly instead. The problem with this, this could be a very large tax. It's subject to 35% tax rate. So it's important for the organizations to really take a look to see what's reasonable and what makes sense. The next couple of slides focus get us back more on private foundations, which are not permitted to undertake lobbying or political activities. And it's important to understand these definitions. What is lobbying? What are political activities? And know that undertaking such activities could result in a taxable expenditure for the private foundation. A lot of organizations do get nervous when engaging in any type of advocacy, and it's important to understand that it can happen just within certain limits, particularly nonpartisan activities that are carried on that are confined to one specific election period, that are not confined to one specific election period, are carried on in more than 5 states, where substantially all of the entity's income is expended directly for the conduct of charitable activities, are okay. When a private foundation grants to a public charity that does engage in some political or lobbying activities, keep in mind the specific project grant rule, which we have on the next slide. And so the following requirements need to be met. Important, the grant is not earmarked to be used to attempt to influence legislation. And a lot of times we'll see that in legal contracts in the first place for private foundations that do granting, where they will have a section that specifically addresses this earmarking portion for the grantee. And the second one is some of all grants made by the foundation for the same project for the same year does not exceed the amount budgeted for the grantee's organization for activities that are not attempts to influence legislation. What that means is that, if there's an amount that's budgeted for exempt activities, but the grant exceeds that, obviously there's, assumption then that some of those funds are going towards lobbying portion, and that's where things become problematic, especially for the private foundations involved. So that's the high-level overview of Schedule C, and with that, we'll move on to Schedule D. Cherie?
Thanks, Maggie. All right, so Schedule D is mostly for IRS reconciliation of assets and revenue and expenses. Readers don't have a lot of value in this schedule, so I'm going to go through this quickly. One of the main areas to look at on Form 990 Schedule D is on Part 10, Line 2. When organizations have audited financial statements, when tax-exempt organizations are required to have audited financial statements, they are required to have something for short called FIN 48 memo. The code is ASC 740, and it's a footnote that says the organization believes that it does not have a tax liability. If an organization might have some type of liability due to excessive lobbying, political activities that Maggie just described, substantial unrelated business income, again, substantial unrelated business income is allowed and doesn't necessarily have to be disclosed in this footnote, private inurement or more than an incidental private benefit, then that would cause this footnote to have to be written in a way that discloses that. And so if you might be concerned an organization could have a tax liability as a tax-exempt organization, you'll want to take careful look at this footnote to see if the organization identified this, or if they didn't and you think they might have excessive lobbying or political activities and they should have identified it, you can recognize that here. Other than that, there's a part Schedule D, Part 6 and 7, I believe, or no, Part 12 and 13. Those are the sections that reconcile the audited financial statements to the 990. Again, a lot of people who are making grants or outside readers don't necessarily look at that information. It doesn't provide value to them when it comes to how much they should donate or things like that. But it is mostly a reconciliation schedule. It also has Part 5 where it discloses the details of organization's endowment for readers who might find that valuable as well. But that's all we'll discuss with Form 990 Schedule D. Now I'll move on to the next polling question.
All right, thank you. So the fifth polling question is, do you donate to organizations who have foreign operations? A, yes, it does not impact our grant making. B, yes, but we ask follow-up questions. C, yes, we like to be able to have an international impact without undertaking expenditure responsibility. D, no, we prefer our grant funds are used or invested domestically. Or E, not sure. And while you're answering that, I do want to remind you that you have the option to submit questions to the presenters using the Q&A window. We do still have quite a bit of content to cover, so if we don't have time to respond during the webcast, we will follow up with you afterwards. All right, here are the results.
Okay, no, we prefer our grant funds are used invested domestically, 41.5%, but 24.4% ask follow-up questions. Okay, interesting. Ever since the events have happened in Ukraine, we've had a few of our clients ask about international grants. So it'll be interesting to see how this changes as that unfolds. All right, now moving on to Maggie for foreign activities.
Thank you, Cherie. So Schedule F, foreign activities. Does the organization spend in foreign country on grant making or direct activities? Is really the question. Does it have foreign investments? If yes, what types? Foreign branches or affiliates? Those are the kind of questions this schedule addresses. And as Cherie mentioned, it has been more of a hot topic recently due to the events. And I think almost every single audit committee presentation this spring with boards we've seen that question come up. Do we have any investments in Russia? And so moving on to the next slide is Part 4, but Part 1 is where you would, where we often see allocations, and they don't have to be to the dollar. The schedule does allow you to round to the nearest thousandth. But you could glean and take a look to see where, in general, which regions the investments are in. If they're alternative investments, which is probably most commonly what we see, the organizations would have foreign filing requirements, such as Forms 926 and 8865, which are filed as a result of investments in foreign partnerships and transfers to and from these partnerships directly or via a foreign corporation. Less commonly, the investments are directly in the foreign corporations, which would be requiring Form 5471, and there's certain thresholds for that. And Forms 8621, which is the PFIC, are even less common, as there's other rules that typically we're able to mitigate filing those. And that pretty much is Schedule F. And with that, we will move on to Schedule G. Cherie?
Thanks, Maggie. All right, Schedule G, this is the reporting of fundraising. We'll get right into it since there's a lot to cover here. The Schedule G Part 1 is where the organization discloses relationships with professional fundraisers. We provide a summary of the definition of professional fundraiser here because this is where we see a lot of mistakes happen when it comes to being provided information for reporting. So a professional fundraiser is a non-employee. They have custody over the funds being raised, meaning they have the funds and then they allocate to the organization the amount due to them after the fundraiser, and they act on behalf of the charitable organization. Keep in mind this can include some grant writers as well. The IRS asks gross receipts, the amount paid to the fundraiser, and the amount retained by the organization. This is important to determine whether or not a fundraiser is being overpaid or overutilized. Let's say they receive a large amount of the funds, but there's very little fundraising. This is where certain red flags can pop up. So that those numbers, those amounts are required to be reported on this section. Schedule G, Part 2, this is where fundraising events are disclosed. There's a question in the Q&A, and I'm going to address that here. So we'll go line by line. So Schedule A, Part 2, the organization discloses their top 2 fundraising events, and any other fundraising events are consolidated in column C. For line 1, gross receipts, this is where the organization reclassifies as gross receipts that were reported as contributions away from special events. So it's important for an organization when they're collecting contributions to identify which contributions were from a fundraiser and which were for other purposes. Those gross receipts are disclosed here. If an organization received auction items, this is where it gets very tricky. The organization is supposed to disclose the fair market value of the auction item here under gross receipts. And then when we get to line 2, and we'll stay on line 1 because there's one more thing I wanted to add. Gross receipts also include, if this is a golf fundraiser or some type of fundraiser where an activity is being done, any receipts for that activity. So if they're paying for, to play golf or something like that, that would be reported here as well. So we have contributions, donated auction items, the amount people paid for the donated auction items on line 1, and any receipts for actual activities taking part in the fundraiser here on line 1. The tricky part here, and I guess I should say tricky, confusing part, is on line 2, we actually have to reduce the amount of fundraising income by the amount of contributions received. On line 1, we reported all of the amounts received from the fundraiser. On line 2, you subtract all contributions received. So if somebody came to the fundraiser and didn't do anything and only donated, let's say $100, that $100 would be subtracted here. Those donated auction items, the fair market value, would be deducted here. The person who purchased an auction item, the amount that they paid over the value of the auction item is deducted here because that's considered a contribution. So once we deduct line 2 from line 1, we get to gross income, which for many tax-exempt organizations can significantly reduce their tax-reported fundraising income. Some organizations do very well on their fundraisers, but for 990 purposes, it looks like they didn't make any money. And that's okay. The IRS here just wants to see how much did you actually make from the fundraising activity. That doesn't include contributions. Lines 4 through 10, this is where all expenses are reported. Non-cash prizes, cash prizes, rent facility costs, food and beverage, things like that are disclosed here. And as it says on the slide, again, a loss reported here does not signify an unsuccessful event because of that line 2. Schedule G, onto the next section, it also asks about conducting of gaming events. Legally conducting gaming events, there's a lot of requirements there, and the requirements are state by state. California has their own gaming requirements, meaning there's certain gaming that is not allowed and some gaming that is allowed. The organization has to enter the states in which the organization conducts gaming. It has to answer whether or not the organization is licensed to even conduct gaming, which is required for California organizations. If the license is revoked, that has to be disclosed there. And there's also line 17 where the organization has to disclose mandatory distributions. So if the state requires, the charity has to make distributions from the gaming proceeds to retain the state gaming license. That has to be reported here. For California, that's 90%. And with that, I'll move on to Schedule L. Take it away, Maggie.
Thank you. So Schedule L, insider transactions. I'm not sure how much time our audience spends on this, but the schedule uncovers any reportable transactions with any disqualified person, which may possibly indicate that there may be fraud or excess benefit. It often identifies certain permissible transactions that occur between the organization and disqualified person. More specifically, the schedule is used to provide information on particular financial transactions or arrangements between the organization and its insiders. There are transactions or arrangements that present issues of conflict, independence, or bias directly relevant to the board's decision-making process. So Schedule L disclosures should be considered part of the broader process of preserving impartial decision-making, particularly as it relates to transactions between an exempt organization and its current and former insiders, which are the key decision makers of their organizations. There are 4 parts of the schedule that may be applicable and required to be completed. It needs to be completed, as mentioned already, if engaged in an excess benefit transaction with an insider during the applicable tax year, or if there was a loan to or receipt from an insider or highly compensated employee, and such loan was outstanding at the end of the applicable tax year. Also, if a grant or other assistance was provided to an insider or substantial contributor, or to any person related to an insider or a substantial contributor, or if there was a direct business relationship with an insider or someone related to them. Important note is here is, if you're ever looking at it, to consult instructions, as there are different definitions of insider for each part of this schedule. So for purposes of Part 1, all access benefit transactions must be reported. There's no threshold, no dollar threshold. Loans with interested persons in Part 2 report loans, salary advances, split dollar life insurance arrangements that are treated as loans, and other advances, except for those advances under an accountable plan, for example, pledges that count as charitable contributions or accrued compensation payable. So only those loans that are outstanding as of the end of the tax year should be reported. Just want to emphasize that again. And Part 2 also inquires about whether the loan is in default. If it is, if it was approved by the board of directors, and if there was a written agreement involved. For Part 3, grants and assistance to insiders, including substantial contributors, should be reported. However, names of these individual recipients do not need to be disclosed. We often see that with educational institutions, for example, that provide scholarships to a child of what's considered an insider attending the institution, and that is in that reporting exception. So those grants to insiders as members of a charitable class don't have to report the names of these individuals. Part 4 highlights any direct business relationships between the public charity and an insider, and there are specific thresholds here depending on type and frequency of occurrence. A former chief investment officer who, for example, now works is no longer, is a former and works as a consultant and is paid fees annually in excess of $100,000, would be someone who triggers the threshold. And there is a 5-year look-back rule for former. So really, since we're getting close on time and I want to make sure that we get to the other schedules, I think the key with Schedule L is having the organization fully understand who are these interested persons, tracking them, and making sure that all the parts are in line. And it's a good sign of good governance if you know exactly who you're looking at and what are the necessary diligent requirements with respect to identifying of these transactions. And with that, I will turn it over. Oh, we have a polling question, Amy. Last one, I believe.
All right, yes. So our last polling question, would you make a grant to an entity with a Schedule L transaction? A, yes, it doesn't bother me. B, yes, only if their conflict of interest procedure was thoroughly explained on Schedule O. C, yes, if the organization provides an explanation as to why the transaction with an insider was undertaken. D, I'd be hesitant, but if it was a well-governed organization, I might. Or E, never. And then also, once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window in your console. All right, let's pull up the results.
Interesting. Most say they would be hesitant. Many say that if it was well explained on Schedule O, it would be a yes. And again, answer C also alludes to proper explanation. And that's what we always tell our clients, is to be transparent. Those things do happen. I think back to an organization that had a board member who departed and upon departure had an outstanding balance of a transaction that was never repaid. And that organization was very distraught because for 5 years moving forward, that person was considered a former, and this transaction had to be reported. It was not a transaction that they entered into upon with an agreement or any board approval because it was in a normal course of business at the time it occurred. But we did encourage them to just thoroughly explain the details, and hopefully the reader or the viewer of the 990 can understand that, you know, in many instances, these transactions are appropriate and are okay. So with that, we will move on to Schedule M.
Thanks, Maggie. Okay, Schedule M, non-cash contributions. It is what it says it is, non-cash contributions. It's actually becoming an interesting schedule as more tax-exempt organizations receive cryptocurrency. So let's get into it. When to record non-cash transactions. So organizations should record their non-cash donations as soon as they are received. They're supposed to use an estimated value either based off of GAAP requirements or internal policies. One thing to note is donated services are for 990 purposes, not for GAAP purposes, not considered donated or non-cash contributions. They're actually not even reported on the 990 other than the reconciliation schedule where we reconcile the 990 amounts to the audited financial amounts. So donated, somebody donates time as an attorney to the organization, that's not reported on the 990. But if an organization has special skills and let's say a doctor purchases equipment to help an organization. That equipment would be considered non-cash item, but the doctor's time would not. So not the best example, but just wanted to highlight that donated services normally are not reportable on this section. The valuation of non-cash items, again, are determined by the exempt organization or when recording on the books. But when it comes to providing the donor acknowledgement letter, the organization does not include that on the acknowledgement letter. So it's up to the donor to provide a value of the item and report that on their personal tax return. It's not up to the tax-exempt organization to validate that. The valuation technique is contemporaneously documented and should be consistently applied. It's also good for an organization to have a gift acceptance policy. So even going back to cryptocurrency, let's say, the cryptocurrency could become a prudency issue because of its volatility. So it'd be good for an organization to have a policy that says how much they can receive or whether it should be sold upon receipt, things like that. And again, the reporting of non-cash contributions on the books normally should be recorded as revenue and an expense. So, for example, the donated auction items would be recorded as a donated as a contribution, right? But it'd also be an expense because it would be a non-cash prize going out. Another thing to note is that Schedule M is only required if non-cash contributions exceed $25,000. So if there's only minimal non-cash contributions received, while they should be reported on Statement of Revenue, you can see that arrow there to line 1G, we do not have to complete a whole Schedule M for minimal non-cash contributions. And with that, I'll hand it over to Maggie for Schedule R.
Thank you, Cherie, and we will close right on time, so I encourage anyone else, if you have any questions, please put them in the chat. We will respond to those even if we run out of time. So Schedule R is related organizations. So what organizations are closely affiliated to the filing entity and how they are related. There's 6 parts. Parts 1 through 4 and Part 6 identifies the related parties, and they could be single-member LLCs, such as disregarded entities, partnerships, C Corps, other tax-exempt entities, and such. And so any of those should be listed on the respective parts. And then Part 5 is where the filer reports certain transactions with any of those related entities. And there's 19 categories. And if there's certain thresholds that are surpassed, like $50,000, or if there's and there's other rules, those transactions may need to be reported in greater detail on a single line. But I think what's most important for Schedule R is that reporting by all the affiliates should agree. So if you find on a Schedule R another tax-exempt organization that the organization you're looking at is reporting, you would expect that if you go to that organization, Schedule R, the organization you're looking at is listed there. So those are just some of the key things that are important, that they're consistent, especially when it comes to some of the compensation of shared staff and the different thresholds. So with that, I want to thank you all for joining us today. And again, I encourage you, since we are essentially out of time, to put any of the questions in the chat.
All right, thank you. And thank you, Maggie and Cherie, for a great presentation today. And also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. And we will email out a copy within 3 weeks should you have difficulty downloading it now. And finally, here is a link to an online survey where you can provide feedback for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.